Hi, good morning to everyone. Now we are into the third day of the course. That is, we covered 2 days. We covered a full topic on the first day, that is banker-customer relationship, leaving only a small portion of the topic for the second day. But on the second day, with the when we covered the part of the first lesson as well as part of the second lesson, we are left with a considerable part of the second lesson, which is negotiable instruments. Especially, there was a bit of a technical area where I was supposed to talk about conversion and the certain immunities available to bankers in two different capacities, that is paying banker as well as the collecting banker. I thought of covering that part, but at the same time, I realized that I included probably one or two slides on payment and settlement systems as well in the bills of exchange, the negotiable instruments lesson. But I realized that the immunity part, the immunities, privileges available to bankers would be made clearer if I cover a comprehensive topic on electronic transactions as well. So I will be covering the part that was not completed that day after 2-3 lessons, probably after doing electronic transactions as well. That was a sudden kind of a decision because of a certain discussion we had yesterday with my colleagues. There were a lot of confusions about electronic transactions area among my colleagues. So I thought of having a comprehensive topic with you on electronic transactions and then relate electronic transactions to negotiable instruments once again, and to discuss bankers' immunity after all those things. So I thought of going into a new topic today, which is very important as far as this course is concerned. Although this is going to be a new lesson, the slides I'm using are a bit old. I think I have prepared these slides for probably for the same course or something else at IBSL about at least 5-6 years ago. I just thought of running through these slides and take you through an important area, I think main area of your topic, which is laws relating to banking. That is, when I say main area, what I mean is that although we are talking about a lot of laws, including electronic transactions and several other things, the main statutes governing banking in Sri Lanka will have to be discussed separately. That is what we are going to do today. So I'll be discussing laws relating to licensed commercial banks and licensed specialized banks today. To cover this topic, I would first ask you a question. Why banks? Why do we talk about banks so much? Are they special? Right? To this topic, I'm sure that all of you, majority of you being bankers, would say, yes, banks are important. Banks are special. Then the question is, why banks are special? What is the reason why banks are special? Just because you are working there, are they going to be special, or are there any specific reasons why banks should be given a special treatment in law? We'll go into basics and we'll go into basic anatomy of banking transactions and see why there should be a special treatment that should be extended to banks, and what is the justification for it, and what is that special treatment that has been given in statutory law. I'm going to discuss something about the mandate of the Central Bank of Sri Lanka in connection to this topic. Basic reason being, you may remember in the very first topic I told you the nature of banker-customer relationship in common law. You may remember I talked about Foley versus Hill and similar judgments where English judiciary pronounced that banker-customer relationship is a contractual relationship where the bank is the debtor and customer is the creditor, since the contractual relationship is akin to a relationship between debtor and creditor. Bank was considered to be a debtor and customer was considered to be the creditor. In that context, you might remember I quoted Lord Cottenham, who said, bank, once the customer deposits money with the bank, that money becomes bank's money. Bank can do whatever that it wants with that money, and the bank is not responsible even if the bank puts that money into jeopardy. That was the general principle governing contractual relationship between bank and customer. But you would see that on that point as well, I mentioned that this kind of this common law approach, this approach towards bank-customer relationship is not a reality in the present environment. The reason being, there are a lot of statutory laws that would override the traditional common law position on bank-customer relationship, and there are a lot of attempts made by the respective legislatures of almost all the countries to keep banker-customer relationship in a highly regulated environment, considering the fact that the normal banker-customer relationship recognized in traditional law, common law, would not be very much appropriate for the protection of the customers. Now, in Sri Lanka also, if you look at the legislation relating to banking and finance, you'll see this approach when the common law recognizes banker-customer relationship as a contract, and contractual relationships are basically governed by the terms of the contract, and money once handed over to the banker becomes bank's money, then it can do whatever it pleases with that money. That kind of approach is going to put customers into real jeopardy. That is why Parliament has enacted several laws to protect the customers. Now we are going into a particular area. Among them is the Montreal Act, by which the central bank was established in 1949. And we need to look at its mandate as well, since it is the authority that has been vested with the responsibility to look after the financial system stability, right? So these are the objectives of the Central Bank of Sri Lanka as set out in Section 5 of the Monetary Law Act. Just have a look at the section. These are the two objectives of the Central Bank of Sri Lanka as given in the Monetary Law Act. You would see that first objective here is the central bank is supposed to ensure economic and price stability, and also financial system stability of the country is also a responsibility and objective of the Central Bank of Sri Lanka. What do you mean by economic and price stability on one hand and financial system stability on the other hand? Economic and price stability is something beyond our topic today. So we'll go into the next part, that is financial system stability. For those who are interested, I would say that economic and price stability would look after the country's price levels. Domestic price stability would be the main concern, and also there is international price stability, in the sense foreign exchange stability is also considered there. You'll see that interest rates and exchange rate and things like that come within the topic, the area, economic and price stability. The area we are going to focus on is financial system stability. That is where you see banks and other financial institutions coming into play. Now, before I go into financial system stability, I don't wish to go into kind of detail into financial system stability. But since we are into financial sector institutions and we are about to talk about laws governing certain financial institutions, mainly licensed commercial banks and licensed specialized banks, I would like you to have an understanding about what financial system is. Uh, the financial system of a country is generally understood as comprising mainly four components. Those are financial institutions, financial markets, financial instruments, and financial infrastructure of the country. Now, this is not something very difficult. You know that in a country, financial institutions play a major role. What are those institutions? Those may be licensed commercial banks, licensed specialized banks. Then there are licensed finance companies. You see registered leasing establishments, leasing companies, and insurance companies. You'll see uh, stock exchanges and stock brokers. Then you'll see certain institutions like unit trusts and so on. Superannuation funds like EPF and ETF. You would see cooperative societies. All these things are kind of institutions operating in the financial system. We call them financial institutions. These are the real players of a financial system. Then for these players to play, there should be proper grounds. What are the places where these players are supposed to play? Those are supposed to be financial markets. Financial markets are the places where you see players in the financial system, meaning financial institutions, interact with each other. They come to the financial market to interact with each other. Two banks will come to foreign exchange market, forex market, and do a transaction. One might sell dollars against euros, right? That transaction in the financial market, forex market, is happening between two institutions in the financial system. That those two players are meeting in a particular place for a transaction. Now you see stock market. A customer who is coming through broker A might want to sell some shares of a particular company. There is a customer B coming through another stockbroker who wants to buy the same amount of shares of that particular company. Now these two needs are being met in a particular place. What is that place? That is in the stock market. Now, two players in the financial system are meeting in the place called stock market, which is a financial market. In addition to this, you can think about say things like government securities market. One might want to invest in a treasury bill or a treasury bond, and he goes to his primary dealer and wishes to make that investment. So he goes into the government securities market. All these markets are also an integral part of the financial system. So you see that there are players in the financial system. These players are the real entities, bodies that take part in substantive commercial transactions in the financial system. Then the entities, institutions, meet each other in financial markets. Markets may include forex market, stock market, and several other things like government securities market and so on. Now you see that when players, institutions meet in these markets, they need to interact with each other using something.
The instruments they are using, financial instruments, would form the third element of the financial system. There are financial instruments that they are using to interact with each other. Now, see, when someone comes to the share market and wants to sell shares to some other person, two stockbrokers are undertaking this transaction in the financial market. The instrument that is being traded is a share. Similarly, the instrument can be a government security, a treasury bill or a treasury bond or some other bond. Or it can be a debenture. It can be a commercial paper. It can be an insurance policy. It can be a unit in a unit trust. Likewise, there can be so many different instruments that are being transacted in the financial system. Meaning, all what happens here is that financial institutions, which are real players of the financial system, comes into financial markets to interact with each other, and in this interaction they would be using instruments. These instruments would include bills, bonds, commercial papers, debentures, and a lot of other things. Now, if we get all these things together, financial institutions, financial markets, and financial instruments, players, playgrounds, and whatever the instruments that are being used for the play, what is the purpose of having financial infrastructure? What is the role of the fourth element? Fourth element also plays an integral part in the financial system for the reason that if not for the financial infrastructure, the interaction between the financial institutions in the market using the instruments would not be done in a very effective and efficient manner. I would take a simple example. If we do not have a particular legal definition, kind of a very precise definition as to what would be the rights of a person who places a government security in a repo transaction. One may be, say, a treasury bond. Who will be getting coupon payments pertinent to a particular treasury bond? That would be a interesting question. It has to be answered very clearly in the law. Otherwise, both parties will be arguing on that. So the legal system, which provides answers for this kind of questions, is an integral part of the financial system, and it is something indispensable. Without a proper legal system, there cannot be a proper financial system performing in the country. Similarly, you would see that about some 20 years ago, the instruments that we had in our financial market were totally different from what we are having today. I mean, as far as the form is concerned, nature is concerned. Treasury bills and bonds are now issued in scriptless form, meaning dematerialized form. There is no paper that is called a treasury bill or a bond. But before 2003, what we had in our markets was treasury bills and bonds, which were printed documents, material documents, scripts. Those scripts were transacted in the financial market, that's true. But the manner in which those were transacted was totally different. A treasury bond would have been transferred from one person to another. How? With the endorsement of delivery, which I mentioned in respect of negotiable instruments topic. With endorsement and delivery, the present holder would endorse the treasury bond and deliver it to the transferee. Now, that was a physical process which consumed time and a lot of other resources. If you look at the present systems available, payment and settlement system, Lanka settlement system introduced by the central bank, now you see all the treasury bills and bonds are in dematerialized form, that is scriptless form, and they are transacted within the system in a very subtle way. Just consider a very simple example of a treasury bill being transferred from one player in the financial market to someone else. Now, you would understand that we are talking about not small sums here, money, the considerations paid in billions. Now, someone wants to buy someone's treasury bond, right? And is willing to pay the consideration, pay the price for the treasury bill, bond or whatever that is being sold. Now, who should do what first? Whether payment should go first or whether the delivery should happen first. These are the things that would give rise to kind of problems. Now, just imagine a physical asset that you are having, some sort of a movable asset. You are going to sell your vehicle. Then you are concerned whether you hand over your vehicle after you get money, or other person might be thinking whether he should give money after he gets the possession of the vehicle. Now, in that kind of situations, you have a lot of safeguards by way of you will not give the key until money is given, and there are certain agreements that may be entered into. Now, you see, when you transfer an immovable property, land or a house or something like that, there is a mechanism how the lawyer who would attest the deed would have to record as to how the consideration passed and things like that. There are mechanisms in the legal system to ensure that real ownership passes with the consideration. But there is a time difference in all these transactions. You can't say that all these things are happening at the same time. If you are going to buy a land, the payment will be made probably after the signature. It will take at least several seconds. There's a difference. But when it comes to large financial transactions, especially when they are done in a scriptless form, there is no document. You don't know whether your ownership is transferred or not sometimes because you can't see it, right? So there's no physical document for you to see. In that kind of a situation, you need to ensure very sophisticated kind of transitions in these areas. Now, in the case of the treasury bills or bonds that I was referring to earlier, if someone is selling his treasury bond to someone else, the present system is such that the transaction is happening on DVP basis. DVP means delivery versus payments. When the delivery happens, payment happens exactly at the same time. There is not even a difference of a fraction of a second. At the same time, two things are happening. Now you see that this is provided by financial market infrastructure called payment and settlement systems. You'll see that this is a considerable improvement compared to the systems we had 20 years ago. Now, with this kind of things, financial system is kept together. I mean, safeguard is the efficiency is looked after, and the secrecy of transactions and everything looked after using this kind of financial infrastructure. So what I want to tell you is that financial system consists of financial institutions, markets, instruments, as well as infrastructure, right? I'll go on to the next area as to what really banks do. Before that, any question on the general description on financial system? Any question? I came back to see whether you all are there. This is a very difficult thing to just speak to a computer screen without seeing whether others are at least even there. Anyway, if you have any question at any point of time, you can raise those questions. I would be using whatever resources I have. What do banks do? What are they doing? They are the center point of the exchange of money. They are the entities that would do exchange of money between the participants. They gather savings. They are the people who collect savings, and they are the people who make loans. They are the people who give loans. They, in doing these things, that is by gathering savings and making loans, they run the payment and settlement system. They run the payment system of the country. They coordinate financial transactions between different players in the financial market. They are the primary provider of financial services in any economy, right? You know these things. They are basically financial intermediaries, right? Why do we call them financial intermediaries? Financial intermediation is that there are certain players in the financial system who would collect money from those who are having money and then provide that money to those who need money. Therefore, the person who are doing this particular activity are called financial intermediaries. They are collecting money from one set of the participants in the system and channeling that money to certain other set of participants in the economy. By doing so, what they are doing is financial intermediation, financial intermediaries, right? මූල්‍ය අතරමැදිකරණයක් බැංකු වලින් කරන්නේ. Now, when it comes to intermediaries, now you may have different feelings of intermediaries. Now, look at the issues that are being discussed these days about the prices of price of rice and things like that. Now, very often we see that in different news media, we see that poor farmers in paddy cultivating areas, they very often complain that they are not getting a proper price for their harvest. Why can't they sell? Because they are not getting the proper price. You see that this is the constant the kind of grievance of vegetable farmers in Dambul and other places. Everyone is saying that we are not getting a proper price. This is unreasonable. They are asking for a certified price for their harvest. Why? Since they are not getting it. If they are not getting that, then these commodities should be very available in the market at a very low price. But if you look at the consumer side, they again have a problem. They say that although these things are very expensive, that is the allegation. Now you see, how can all these things happen? On one hand, farmers are complaining that they are not getting proper price for their harvest. On the other hand, consumers are arguing that they are paying too much for rice, right? And see, who is getting the blame? Most probably, people say that intermediaries, large-scale mill owners, and certain other people who are intermediaries who are getting the profit, who are getting the cut from both sides. They don't pay enough to the producers, farmers, and buy at very low prices, and don't sell at that kind of reasonable prices to the consumers. They sell at very high prices, thereby making a huge profit. That is allegation against the intermediaries. So the general perception in our societies against about the intermediaries is that intermediaries are people not good for anything because they are taking the cut from both sides, right? You might argue that this is very wrong. But when it comes to financial intermediaries like you, bankers, would the same argument apply similarly? can you call that banks are also intermediaries, and these are the people who are getting cut from both sides, and therefore they are the people who are making these problems, right? Uh, in view of this nature of the presentation, I'm not in a position to ask uh, any particular person whether this is correct, but I would generally say yes, this is correct. How do you take cut from both sides? You bankers, you are taking money. In other words, you are buying money from your depositors at very low rates. You pay 2%, 3%, and things like that for a deposit. And then after you obtain that money, as we understood earlier, that money goes into a pool, and from out of that pool, you are paying, you are providing money to certain other people who are asking for money, who are requesting money. Those people are the borrowers. When someone wants to obtain some money by way of a housing loan or to buy a vehicle loan, or something like that, you are charging him a high interest. So you are selling your money at a high price, right? While purchasing that money from depositors at a very low price, meaning a low interest rate. You are selling it to your customers, the borrowers, at a very high price, meaning that you are charging a very high interest rate. Now, this difference, this interest rate margin, is your profit. Can't someone argue that banks are also doing the same thing as what is done by mill owners in the rice market? What is done by the intermediaries in the Dambula vegetable market? Aren't you doing the same thing? I think if someone argues like that, that question is reasonable. I don't know whether there's any other alternative, but that question is reasonable. You are doing the same thing. You are also taking the cut from both sides. But here, sometimes you act as some sort of a necessary element in the society, since those customers from whom you buy money, that is your depositors, cannot reach the other set of people without an intermediary. Now, if rice farmer in paddy cultivation, the paddy farmer in Anuradhapura can meet the consumers in Colombo without an intermediary, probably he would have got a proper price and customers would have paid the proper price. Now, that is not possible for certain practical reasons. That is why intermediaries come in. In the case of banks as well, there are a lot of reasons why the people who are having excess money, meaning people like you and I, we are supposed to have excess money. That is why we are depositing them in banks, our salary and things like that. Those go into banks, and the banks arrange that money to go into the hands of people who are in real need of money. Who are those people? Maybe big construction companies and big multinational companies. They borrow from banks, and banks use our small savings to give loans to those people. In doing so, you see that bank is doing some significant thing. Here, bank handles other people's money. Bank is not having its own money in this transaction. Banks are dealing with significant amounts of other people's money, right? Now, this is something very important as far as banks are concerned. That is why I'm telling you all these things about before I go into real banking act provisions. So banks are handling other people's money. When you handle other people's money, you need to be very careful. Right? That is one rationale. How do we prove that banks are really having other people's money? We know that there are a lot of deposits coming into banks. That's correct. But how do we determine whether it's too large or the proportions are not right or something like that? If you compare the if you look at the balance sheet of a bank, what you get on the liability side, the left hand side of the balance sheet, are bank's liabilities. You see that bank has its capital, then you would see bank's loans, uh, the deposits collected by. I'll explain that first. Sometimes I get this very, I have seen many people get this confused. Now, if I ask you as bankers, what is your biggest asset? Can someone tell me in your balance sheet, what is going to be your biggest asset? I would like someone to talk, otherwise, I don't know whether
Our advances, sir.
your advances to yeah, loans and advances are the biggest asset of a bank. Very often when I ask this question, I remember people used to say, sometimes people say our biggest asset is customers, right? Sometimes they say our biggest asset is employees, right? Those are lies. I mean, people who say uh, biggest asset is the customers, I think that is a myth. I mean, that is something that uh, uh, taught by marketing people. Those who say biggest asset is employees, that is HR myth. No, in financial terms, in the case of a bank, the biggest asset is loans and advances. Right? What is your biggest liability? What is your biggest
Deposits.
Yeah, deposits. Depositors who have given money expect that money back. So it is your biggest liability. Now, I was about to say something about the balance sheet of a bank. If you compare the composition of the liability side of a balance sheet, you would see capital and depositors liabilities, deposit liabilities. If you compare the amount of deposit liabilities against the volume of capital, you will see that deposit liabilities is several times of the uh, capital. Maybe it's 10, 15 times of the capital. That is why we say banks are highly leveraged entities, highly leveraged businesses, in the sense that your borrowed money are much more than your own money, equity. Equity contribution by the shareholders of a bank is comparatively very little, maybe 5% of the entirety of the funds of the bank. The rest is coming by way of deposits the customers have kept with you. So you are running a marvelous business, meaning you are not having enough money, you are using some money with shareholder equity, but something like that, 10, 15 times of that, up to sometimes 20 times of that is coming from certain other people. You are working on other people's money. Since you are working on other people's money, you need to be very careful, because if you run into kind of a problem, what you are doing is you are putting the entire deposit holders, large amount of people who have basically kept money with you, trusted you, are also going into trouble. You put them into jeopardy. For this reason, you need to be very careful in handling your transactions. We'll see how the Banking Act helps you to have that discipline in the financial transactions. There is one other point I have mentioned here, that is point number 3. Banks may have a systemic impact, right? Failure of a bank may trigger multiple failures. This is something very special in the case of banking institutions. Uh, Probably you may have seen certain industries failing. You might be an owner of a particular factory in a particular industry. Say you are having a garment factory or something, and you have certain competitors who are having garment factories. But if a particular garment factory is having a problem, say they got caught in a fire or something like that, and they have not been insured properly, that person is going into trouble. It has no impact on you. Probably your market share is going to be larger because someone is going out of the market. Someone has been eliminated from the market. You will be happy. But if you take the case of a bank in a kind of a culture, banking system, if one bank goes into trouble, that is not something that you can be happy of. You cannot be proud of someone going into trouble. You can't expect the particular share of their business coming in your way, because very likely you may be very closely interconnected with its bank, and their failure might trigger your failure as well. There can be multiple failures triggered by one incident, failure of a particular bank. Now, if you take examples from the global financial crisis after 2007 and so on, you may have seen lot of banks failing at the same time. When one bank fails, so many other banks, depending on certain funds from that bank, in view of the interconnected transactions, would fail one after one. This is what we call domino effect. Or this kind of systemic effect is very peculiar to the financial sector, especially to banks. When a bank fails, it's like very likely that all those other banks which are connected to that bank are also likely to fail. Now, this kind of a nature tells us that there is a systemic impact in the financial market, the banking sector. These are very fragile entities. They are working on other people's money. If they run into a problem, that problem might be very easily transpire transmitted into other institutions as well, and entire banking system might fail within a very short period of time. That is why banking supervision and banking regulation is something very important in any society, in view of this systemic nature of the bank failures. One bank's failure might trigger a lot of other failures. That is why we need to be very careful. And finally, I have said here, bank survival depends very much on people trusting it. To the extent people trust you to be a trustworthy place to keep money, they will come and deposit money. Just imagine, for some reason may not be something valid, the apprehension, the suspicion may not be reasonable, but for some reason, if there is a particular understanding among depositors of your institution that there is something wrong with this bank, we need to withdraw our deposits, then that belief, that simple action might trigger failure of the institution. You can sometimes some of you may remember how certain banks went into trouble because of certain incidents some time back. If I'm to give you an example, in 2008, towards the end of 2008, in December 2008, Golden Key credit card company, which was accepting deposits unlawfully, went into a problem. They were not in a position to repay their depositors because they were not running a kind of a feasible model. They were basically collecting money from certain depositors and giving money, paying interest using those money, the money collected from other depositors, so that they should, in any kind of any institution doing that kind of a thing would run into a problem at some point of time. This entity ran into a problem. Then the then Selenka Group chairman made a public statement saying that I'm going to settle all these depositors. Mama mage bankuwa, Ceylon bankuwa vikunala hari, mage shares vikunala hari man mewa gewanawa kiyala. You see the statement? What he said was he wanted to pay the depositors of Golden Key even by selling his stake in the in Ceylon Bank. What do you mean by selling his stake in Ceylon Bank? If he was a shareholder of Ceylon Bank, he would sell his shares of the Ceylon Bank. Then with that money, he would repay the depositors of Golden Key. It was a practical question whether it was possible to pay that amount of money with his shareholding, because golden key deposit portfolio was something like 26 billion, whereas the chairman of the Seneco group had, I think, only less than 2% in Ceylon Bank shareholding. But what he said was that I would sell my stake in Ceylon Bank and sell the depositors, which was not factually possible, which was not something feasible. But having heard this news, what the customers of Ceylon Bank believed was that our bank also is now in kind of a trouble. So they came to Ceylon Bank branches and started withdrawing their money. With that statement made by the chairman of the bank, now everyone got panicked and came to bank branches and started withdrawing money. When people start withdrawing money like that, even though original statement is not valid or it doesn't have any merit, it becomes a reality that bank is running into problem because everyone is withdrawing their money. Now, I would say that if all the customers, all the depositors of a bank come to their bank branches and start withdrawing all of their money at a particular time on a particular day, irrespective of what this particular banking institution is, it is inevitable. You can't stop that. The bank is going to fail. Whoever who requests money, whoever who asks for their deposits back will have to be paid. If the entirety of the customers ask for their money, there is no way that bank can pay. Why? Bank has already blocked these monies with certain things. They have kept statutory reserve requirement with the central bank. They have kept certain portion of money with their borrowers by way of long-term loans like housing loans and things like that. Lot of things have been done in that way. So no bank is in a position to pay all of its depositors at a given point of time when they come for money. Now, this is a very serious problem. Now, if people come to a bank branch on a particular day, they are not in a position to come. So it's your business. It's your responsibility to run the bank in such a way that people trust you. People will not come to you all of a sudden and ask for their money. If everyone is asking for their money, bank is going to fail, right? So it's a very subtle thing. It's a very delicate business where banks need to have kind of a trust. Bank needs to make their customers trust them, depositors trust them, no matter whether borrowers trust you or otherwise, but depositors need to trust you. If depositors cease to trust you, then it is a serious problem. Then things turn into a serious problem, right? Now, why this problem arises? Again, I'll relate that to the specialty of a banking institution. Now, what I told you was that when customers come and ask for their money, since your monies are blocked in certain other things, certain other investments, and so on, you can't pay. Now, look at the assets and liabilities combination, the nature of these assets and liabilities. You said that biggest liability of a bank is their deposits. The depositors, those who have kept money, is the biggest liability of a bank. What is the nature of that liability predominantly? Is it a long-term liability or a short-term liability? Is it something that can occur immediately within a period of 1 year? Or is it something going beyond 1 year? Short-term and long-term. Liability, the nature of the liability. Deposits? What do you think? The deposits in the bank, are they short-term liabilities or a long-term liability? Anyone, please? Deposits in a liability. You have collected money from depositors. Are they short-term liabilities of yours or long-term liabilities?
It depends on customer segment, sir.
Meaning that there can be current accounts as well as, say, fixed deposits. Is it the reason why you said?
That is one thing, sir. Another thing is, if it is a minor deposits, it will be a long liability, long-term
Yeah,
liability.
yeah, yeah. You can see some sort of kind of distinctions like that. But generally, I mean, ordinarily, if you take it as a total portfolio, uh, customer deposits are short term in the sense that now, if it is a current account, you need to pay immediately. If it is a savings account, still you need to pay. Even if it is a, say, 5-year fixed deposit, if the customer comes to your bank branch and say that I want this money prematurely, still you need to pay. Right? In all these circumstances, basically deposits are short term in nature. Right? On the other hand, predominantly deposits are short term in nature. On the other hand, what about your assets, the loans and advances that you have given? Are they short term in nature or long term in nature? Someone please? Your loans and advances, are they short term things or long term things?
Most of the time it's long term.
Yeah, most of the times they are long term. Predominantly, they are long term. That's correct. And on the other, also, now look at if you take simple examples, a housing loan is necessarily long term. When you give a vehicle loan, probably you collect them in 4 or 5 years' time. Those are long term things. Probably there can be certain very short term loans. Still, the you just imagine the practicality. A customer might come to the bank branch and ask for money. Then you need to pay immediately. Even if you have given a very short term facility to someone, you can't collect that money that swiftly. Therefore, always you run the risk that if the customers can ask for your money, ask for uh, the money they have deposited with you, you are not in a position to pay immediately. If you have, if the entirety of the depositors are coming at a particular time, you are not in a position to pay them immediately. This is the risk in uh, financing long-term assets with short-term liabilities. Your short-term liabilities are deposits that you have collected. You are using those things to finance long-term assets, which are long-term loans. Now, when you are financing long-term assets with short-term loans, you are in a huge risk. If those lenders come to you and ask for their money, meaning customers, depositors, you are going into trouble. On the other hand, if you are financing short-term liabilities with long-term assets, that would have been a great business. But banking is not like that. But banking is, they are financing long-term assets using short-term liabilities. Therefore, it is highly risky. That is why assets and liabilities management is a very serious function in any bank. Right? I told you a lot of things about why banks are special. But even in this context, it is not it is not very uh, rare that people don't know whether the banks are solid or not. A layman who would be having transactions with the bank would not know whether the bank is financially solid. They may appear to be very solid, but in fact, it may not be so. There can be a lot of bad loans in the books, which might give rise to certain problems in the bank, certain liquidity issues, and solvency issues finally. Uh, all these things are not known to customers. So there should be someone to protect the customers as well. Now, this is, as I told you, this is a very old presentation, and I have taken certain information from annual report of 2015 to show uh, the assets of the financial system, the composition of the financial system in this manner. Probably while I go on talking, I can take present figures as well from the most recent annual report. I think that was in page 190 of chapter 8. I'll search. Can you see this screen, the annual report? Can you see this?
Here's the presentation, sir.
Yeah, still is the presentation. Okay. Can you see it now?
Yes, sir.
Yeah. You see this table here? This is the composition of the financial system as at the end of last year. You see the 2019 figures compared to 2020 figures. You see in the entirety of the financial sector assets, banking sector was responsible for something like 72.5%. 72% of the assets of the financial system were with the banking sector. Out of that, 10%, was with the central bank. Was the central bank was holding on to 10% of the entire financial sector. Licensed commercial banks, all the banks collectively had 54%, and licensed specialized banks were having 7% of the financial system. If you compare this 72.5% with the other places, the other sectors, non-bank financial institutions, licensed finance companies and cooperative societies and so on, they had 6.9%, out of which 5.8 was held by licensed finance companies. Other licensed specialized institutions, including leasing entities and so on, they had just merely 1.8% of the financial system assets. You see certain players which you think that are big players like primary dealers, they are having only 0.4%. Stockbrokers only 0.1%, and likewise there are small holders of financial sector assets. Again, another 18.8%, a large portion, is held by contractual savings institutions, including superannuation funds. You see insurance companies holding 3.4%, and employees provident fund having 12%, and ETF 1.6%, and approved provident funds and pension and provident funds having 1.5%. And likewise, the composition of the financial sector is such that you see banking sector is dominating, right? Now I'll take you back to the slides. You see here, I think it's not very different from today's context. Central bank is having something like 10%, commercial banks 51%, finance companies, yeah, I think it was almost similar. This was 2015 figures, what I just showed you 2020 figures. So you'll see that if you look at this slide again, central bank is having 10.4, Commercial banks are 51.1. Specialized banks this much. Finance companies, insurance, leasing, primary dealers, and EPF. You'll see that the components given in this slide, other than insurance companies, everything else are either the central bank or the entities regulated by the central bank or certain departments of the central bank. First one is central bank. Commercial banks are regulated by central bank. Specialized banks are regulated by central bank. Finance companies, leasing companies, and primary dealers again are regulated by central bank. EPF is a department of the central bank. So you'll see the very large majority of the assets are some way or the other managed by the Central Bank of Sri Lanka. So there is a regulator role, especially coming in as far as the financial system stability is concerned, because they are in control of or in kind of the regulation of at least a large portion of the financial sector assets. When it comes to regulation, supervisors always needs autonomy. They need the environment to act independently. That is there. Accountability should also be there. The regulator's power is not a blanket guarantee that banks will not fail. On the other hand, regulators need to be accountable for doing their function properly, but it's not a certificate. It's not a guarantee that supervision is going to prevent any kind of failure in the financial markets, because banking is a business. Right? Failures are possible. Profits as well as losses are possible. Continuous losses might lead you to collapse. That's possible. So you need to do business while making profits, but at the same time, that profit making process should be something very safe and sound. That is what is expected from the regulator to look after. And do regulators need to be transparent? Even if they are supposed to be transparent, is it the case at all times? Or I would argue that there is some sort of a place, some room for constructive ambiguity as well. Meaning that sometimes if the regulator is always transparent and always giving hints as to what the regulator is going to do, the banks who are into business might be in a position to, would be certainly in a position to judge what the regulator is going to do next and should prepare their arrangements accordingly to suit the regulator's next action. That is good as far as the good things are concerned. If things are going in the other way around, then regulator will have to be little ambiguous, constructively ambiguous, meaning that certain information may need not to be given to the participants at certain times, right? I'll give you a simple example from the global financial crisis. Probably you may remember this bank called Northern Rock Bank. That is the bank that collapsed in 2007, the UK. By the time the Northern Rock Bank collapsed, the UK, the people, the depositors of the country were not very much familiar with kind of failures of banks. On the other hand, in the US, it's kind of a very frequent phenomenon, whereas in the UK, bank failures were not heard of. I think the last bank failure prior to Northern Rock was recorded in some 150 years ago. So no living person had experienced a bank failure at that time. Now this Northern Rock Bank, which was basically having a lot of deposit from elderly people, their retirement benefits and so on, was not managed in their assets and liabilities position properly. There was some sort of assets and liabilities mismatch. When that was there, this bank found it difficult to repay some of their customers because they were not that they were insolvent, not that they were having a solvency problem, not that they were not having assets. They had everything, but there was kind of assets and liabilities mismatch. When a lot of people asked for money, they were having some problems in repaying them because they did not have liquid money. Liquid cash was not available with them. So they wanted to solve this problem. Rather than sending customers away, they wanted to somehow support them. Naturally, when it comes to central banks, we call central banks lenders of last resort. Lend of last resort facility, or which is very commonly known as LOLR, is a facility extended by a central bank to a bank in need in certain circumstances. Certain circumstances mean that if there is a imminent financial panic in the financial market, and if that is caused by a temporary liquidity issue of a particular bank, then the central bank would come in and extend this discretionary facility. When I say discretionary facility, what it means is that there is no guarantee that the central bank would give this facility. There is no right available to any banker to tell the central bank, look here, we are in trouble, we need your money. There is no bank can ask for this money as of right. This is a discretionary facility available to central banker to extend LOLR or not to give that facility. Now, in my example, Northern Rock Bank approached Bank of England, that is the UK central bank, and asked for lend of last resort facility because they were having some liquidity issues, and to pay prepaid depositors, they wanted some money. Then central bank, I'm just wondering who the governor was. Was it Eddie George or no? Governor Mervyn King. Governor Mervyn King decided to extend that facility, lend of last resort facility. When lend of last resort facility was given, there was a requirement, understanding in the central bank, that is Bank of England, that when that kind of facility is given in view of a certain European Union regulation, they were required to announce the fact that LOLR facility was given. So Bank of England announced that we have given this much of money by way of lend of last resort facility to Northern Rock Bank. When this announcement was made public, a lot of people who were earlier clueless of the problem in Northern Rock Bank came to know that there was a problem in Northern Rock Bank. Right? They also came to Northern Rock Bank asking for their deposits. Another set of people came in asking for their deposits. Now, it was in the public domain. Earlier, it was a kind of a problem within the particular bank, Northern Rock. When they informed them to the central bank and got money, since central bank announced it to everyone, now it was a public issue. Everyone who had deposits in Northern Rock Bank were alarmed. A lot of people came and got their money. Since they were withdrawing money, Northern Rock had further problems. They again approached Bank of England and asked for money. Bank of England considered their financial position, whether they can keep collaterals and so on, and were happy that they can give money. Again, money was given and made an announcement to say that we again give that lend of last resort facility to Northern Rock. That triggered a lot of reaction from the depositors, and depositors came and asked for money again and again. Northern Rock Bank turned to the central bank, but by that time they were running out of collaterals that were acceptable to the central bank, so they could not secure any more facilities from the central bank. And it resulted in the collapse of the bank. Northern Rock failed, right? Who is to be blamed if you want to blame someone in a collapse? Is it the mismanagement of assets and liabilities in Northern Rock Bank? Yes, that is a serious concern. If they were managing their assets and liabilities in the proper manner, they should have been in a position to repay the depositors when they came to the bank first. Not in the second and third waves, but in the first time. If a bank is finding difficult to repay depositors under normal circumstances, there is something seriously wrong. But when it comes to second and third waves, when people come in large numbers to collect deposits, that may be beyond their control. But initial problem was triggered by their mismanagement. Then who else can be blamed? Look at the behavior of the central bank. They made the facility kind of a public thing. They made a public announcement. That triggered a lot of people to come to the bank and ask for deposits. They are to be blamed to some extent. Yes. Later, there was a commission, a royal commission on failure of Northern Rock. I remember there was some sort of a tripartite agreement between central bank, exchequer, and so FSA, I believe. How that particular arrangement failed was discussed and so on. There, it was a question whether the central bank did the right thing by announcing that they made a LOLR facility available to the bank. Bank of England was of the view that they were under obligation to do so. But European Union lawyers pointed out that, no, you were not under obligation. Central bank was under obligation to disclose certain things, but not this particular action. You cannot declare LOLR facility. You can't publicize it. It is something that you need to do very secretly. That was the idea, right? So you see that the point I wanted to drive was that sometimes there can be some constructive ambiguity. Without that kind of ambiguity, you are not going to get the results. Now, if every bank, if all the banks operating in an economy thinks that if we run into problems, central bank will come and bail us out, then there is no incentive for them to be good. Now, if we go to bank A, who is in trouble, and central bank gives money, bank A somehow survives. Then bank B thinks, if A got money, why not us? We also do some risky thing, and if there is a problem, central bank will come and bail us out. Bank C, D, E, and everyone will do those things. So it's moral hazard. It's against good governance. Why? Everyone is doing banking in a reckless way so that they can get central bank assistance. That is the very reason why central bank need to be little ambiguous, constructively ambiguous in these areas, and central bank need not to be 100% transparent in this kind of things. Now, if I look at our own experiences in 2008, when a certain bank, I mentioned it earlier, was in trouble, did you hear that central bank gave lend of last resort facility and things like that? No, we didn't use those terms. We didn't tell anyone that we are using this particular thing. But in fact, we were giving a lot of money. I remember day by day we were doing this. And finally, within 2-3 days, we were in a position to ensure that customers believe the bank, and we gave very serious messages that we are working with certain strong entities to take the situation under control, and bank was basically rescued. Now that could not have been possible if you were unnecessarily transparent in all the areas, right? So that is why constructive ambiguity is necessary, because this kind of facilities very often promote moral hazard. And I particularly remember this incident in 2008 when we were having the basically help in the institution to survive. We had to maintain kind of a very low profile, but doing a lot of things. If you come to the media and say that we are going to do this and that and things like that, people will calculate. People will see how much of money you are going to get from that institution. Would that be sufficient for the bank to pay all the deposits and things like that? No, that is not the way. We need to be little kind of it should not be a very open operation, right? Having said that, what does regulation mean to banks? Banks might think that they are licensing us, they have stringent capital requirements, they are imposing us restrictions on ownership. All the activities are subject to restrictions. Your lending, liquidity position, reserves, and they scrutinize the operations of the bank from a governance perspective. All these things are there from the perspective of the regulated entities. In doing so, Tina, Anna, Tina. Sit here. Hello. In doing so, the central bank in Sri Lanka is basically using two statutes. One is the Monetary Law Act number 58 of 1949, and the other one is the Banking Act. I want to go into the Banking Act, but I wanted to give some sort of introduce like this kind of a lengthy introduction, and then go into the Banking Act, the Montreal Act as well, to explain certain things, and then go into the Banking Act. The discussion on the Montreal Act will be very limited. You will see the long title of the Montreal Act here in this slide. This long title says that this is an act to establish the monetary system of Sri Lanka and the central bank, to administer and regulate the system, and to confer and impose upon monetary board of the central bank powers, functions, and responsibilities necessary for the purposes of such administration and regulation. So basically, to introduce the central bank and confer certain powers on the central bank to do these things with regard to financial system. In the Monetary Law Act, Bank Supervision Department is specifically referred to in Section 28, and it says, for the purpose of the continuous supervision and periodical examination of all banking institutions in Sri Lanka, the central bank shall establish and maintain a department of bank supervision. This is the requirement. Central bank shall establish and maintain a department called bank supervision, and the head of the department shall be called the director of bank supervision. For your information, in the entire Monetary Law Act, there are two departments specifically recognized. One is the Bank Supervision Department. The other one is the Economic Research Department. Everything else in the central bank have been established later on using Section 33 of the MLA. At the time the central bank was established in 1950, there have been 5 departments, including these two. These two are the only departments recognized in the law, right? So Section 29 of the MLA says that there is a duty to examine the books and accounts of every commercial bank in Sri Lanka at least once in each examination period, and to make further examinations in respect of any specified bank whenever the governor requires to do so. So periodic examination and sometimes special examinations were enabled by Section 29. There is a duty on the part of the Director Bank Supervision to furnish examination report to the governor. There are certain powers to obtain information from financial institutions, the banks, DBS, Director Bank Supervision exercising those powers. Failure to submit information amounts an offense. So there is a very strict regime where all these things are done. Under the Banking Act, there is also Section 30, which says the Monetary Board may suspend the business of a banking institution upon review of the report prepared by the DBS and submitted by the governor, which shows that DBS is satisfied that the institution is insolvent or the institution is likely to become unable to meet the demands of its depositors, or its continuation in business is likely to involve loss to the depositors or creditors. In these instances, the Direct Bank Supervision can prepare a report and submit it to the Monetary Board. Monetary Board may suspend the business of a banking institution based on these. You'll see the first point. This is something I want to mention. The institution is insolvent, right? That is a situation. That is one of the situation in which the Direct Bank Supervision can recommend and the Monetary Board can decide to suspend the license of a banking institution. The institution is insolvent. Look here, the situation. Just compare this to what I mentioned about provision of lend of last resort facility. Now, it clearly shows that lend of last resort facility is given when the institution is not insolvent, right? Now here, if the institution is insolvent, central bank is going to cancel the license, suspend the license and take action. After suspension, there is a possibility of reviving the, reversing the suspension and reviving the business, or go into liquidation of the entity, right? That is when the institution is insolvent. But what I mentioned earlier is that you can expect the central bank to give lend of last resort facility if the institution is not insolvent but having a liquidity issue. If there is a concern that the banking institution is not having sufficient liquid assets, then it is possible that lend of last resort facility could be provided to them. But if the institution is insolvent, that is not the way out, right? In other hand, what it means is that if the institution can be revived, ගොඩ දාන්න පුළුවන් නම් last resort දීලා ගොඩ දාන්න. If the institution has some problems that it cannot be revived, then the central bank does not get involved in reviving it, but would go on to cancel the license and suspend the business, and if necessary to cancel the license as well. Now, this is a very clear distinction that we need to make, because just because the bank is running into problems, they are not going to get money from the central bank. They will get money only if that problem is associated with a temporary liquidity issue. If it is a solvency issue, they are not going to get that assistance, right? This kind of a suspension is valid for 6 months. Within such period, the institution should be allowed to resume business, or winding up proceedings should commence, right? If there is a correction, that correction can be done, and they can we can let them to restart business. But if it is not possible, then winding up proceedings should commence, meaning that the company has to be liquidated. This provision is applicable to licensed specialized banks as well. Now, before I go into the Banking Act, again something came into my mind. about this suspension and resultant positions. When an institution is suspended, within the 6 months period, it can either be revived or with certain action, it can be, it is allowed to be function, or it may go into liquidation, right? Probably you might remember there was this entity called PSDB, Pramukha Savings and Development Bank, which ran into problems in September or October 2002. The license was cancelled, and finally it could not be revived. Therefore, there were certain attempts that we initiated a liquidation action. But liquidation, you see that after suspension, it was not revived. It went into liquidation. When the liquidation action was going on, there was another move to form another bank and transfer assets and liabilities. Accordingly, those were transferred to Sri Lanka Savings Bank. That is how Sri Lanka Savings Bank came into operation. That's a different story. But there you see that after the suspension, decision was not to revive, but to liquidate. On the other hand, in Ceylon Bank case, what do you think? What happened? Right? Was there a suspension, and after suspension, was there a revival, or whether we went into liquidation? If that cannot be the case because the bank is still there. Any guess as to what happened in Ceylon Bank? Was it suspended? I think rather than telling no, I think if you can see these, know something about these incidents, you would understand how practically these things happen. Right? Any idea whether Ceylon Bank was suspended or not in 2008? We have some 20 participants. I think that's including me and Menakan. So at least 17, 18 people are here. Probably someone having experienced those days. I think a lot of you joined the banking sector after that. Still, any idea? Any idea whether Ceylon Bank was suspended? Not sure. Menaka's attendance sheet contains NIC numbers as well, so I can just go by your date of birth and guess whether you have been in the banking industry those days. Anyway, for your information, Ceylon Bank was also suspended. But it would be very interesting to know the duration for which Ceylon suspension was there. Now, in the case of Pramukha Savings and Development Bank, it was initially suspended, suspension was extended, and likewise, suspension went on for a quite long period of time, several months, I think, if not for several years. Right? In the case of Ceylon Bank, what was the duration of the suspension? Ceylon was suspended just for 15 minutes, right? You might wonder, what is the purpose of suspending an institution for 15 minutes? The reason is that you'll see that we were allowed in terms of law to take certain actions to revive the institution only after its suspension. So technically it was necessary that for us to intervene at that particular point, there was a need for a suspension. So it was suspended, and suspension was not announced properly. It was suspended at the close of the business on a particular day. I think it was a Friday. Friday around 4:30 or 4:45, we suspended the bank, and within 15 minutes, it was revived. Right? That is the subtle regulatory action you expect from a regulator. Right? If we announced on a Friday evening that we suspended the institution, and wait till Monday or next Wednesday or something like that to give the solution, then it would have been a major failure in the country. Instead, what we did was we collected all resources and arrangements were in place to get other management assistance from other institutions and pump in money wherever necessary. Having gone into all these things, suspension was imposed just for the technical reasons for 15 minutes, and within those 15 minutes, all those actions were formalized and banks started working. So no one felt that. No customer was having difficulty because of the suspension. Right? Everyone was happy finally, especially happy when the bank was basically revived. So in that context, now I'll go into the real substantive provisions of the Banking Act. These are the provisions of the Banking Act that we are supposed to discuss. This is the long title. Long title of the Banking Act says, this is Banking Act number 30 of 1988. It says, it's an act to provide for the introduction and operation of a procedure for the licensing of persons carrying on banking business and of carrying on the business of accepting deposits and investing such money. See, a long description is there. For the regulation and control of matters relating to such business and to provide for the matters connected therewith or incidental thereto. And we'll go into simple details first. Who can do banking business? Section 2 provides that no banking business shall be carried on except by a company under the authority of a license issued by the Monetary Board with the approval of the minister. So no one can carry on banking business without a license issued by the Monetary Board with the concurrence, with the approval of the minister. Minister here is the minister under whose responsibility Banking Act comes in. Generally, it's the finance minister. One can conduct banking business only with a license issued by the Monetary Board given with the approval of the minister. Any entity that has been issued with that kind of a license is called a licensed commercial bank, right? So you may remember we discussed on the very first day as to what a bank is in terms of English common law. We were going into cases like Bank of Chettinad matter, then DMT versus Kirkwood, UDT versus Kirkwood, and so on. And we discussed what a bank is. That day also I mentioned something about Section 86 of the Banking Act, since it defines banking business. Now this is the relationship. Section 2 says no one can do banking business in Sri Lanka unless you have a license issued by the Monetary Board. An entity that has a license under those provisions is called a licensed commercial bank. What are they supposed to do? Banking business. This is what we discussed on the very first day as well. This is the definition of banking business, which I showed you on that day. It says a banking business means the business of receiving funds from the public through the acceptance of money deposits. So banking business necessarily entail business of receiving funds from the public through the acceptance of money deposits. You collect money deposits. What kind of money deposits? Payable upon demand by check, draft, order, or otherwise, right? You see, money deposits payable on demand. Money deposits payable on demand is, as I mentioned that day, these are current accounts. These are current accounts. Payable on demand means these are demand deposits. So if you are collecting money deposits, which are demand deposits, then you can become a banker provided that the other parties also fulfill. You see that there's the word "and" here. payable upon demand by check, draft, order, or otherwise, and you collect money by way of collect money deposits which are payable by demand, payable on demand, and you do something. This and is very important. If not for this part, if this not for this connection between the first part and the second part, it's not a banking business. And the use of such funds either in whole or in part for advances, investments, or any other operation either authorized by law or by customary banking practice. You collect deposits and use such funds to give advances, and you may invest that money in certain things, and likewise you do have that money. But it's an integral part of this definition that you are collecting monies payable upon demand and use that money for your loans and advances and investments, etc. This is banking business. No one can do this without a license. In other words, you can't collect money from general public which are payable on demand and invest that money anywhere unless you have a license license issued by the central bank. Right? That is the explanation here. Any question on this? Any question on banking business? We'll go into deposit, because now here you see this red color letter first. What comes first? Acceptance of money deposits payable upon demand. That's a different thing, but acceptance of money deposits is part of banking business. What is a deposit? Deposit includes, it has given a lot of things. Includes a sum of money accepted from any person as a business on terms under which it will be repaid with or without interest or premium, and either on demand or at a future time, or in circumstances agreed to by or on behalf of persons making the payment and the persons accepting it, provided that the person accepting the money is a person who in the usual course of business lends money, makes or makes available the use of the benefit of the money so accepted to third parties, and also includes and goes on to include certain entities. So if you are accepting deposits from general public and using that money to give loans, then what you are doing is banking business. You cannot be doing banking business unless you have a license. Then licensing process is such that there should be a written application for the license, generally by a company, and it may or may not be listed depending on regulatory decisions. There is a need to comply with Schedule 2 and 4. Schedule 2 is the list of activities that a licensed commercial bank can carry on. Section 4 is the list of activities that a licensed specialized bank can handle. Still in the process of these provisions, the Section 2 and other things are related to licensing licensed commercial bank, not specialized banks. But in this slide, I have mentioned Schedule 2 as well as Schedule 4. Articles should be approved by the Monetary Board. There can be investigations done by the Monetary Board if necessary. Right? Then licensing contains issue of a letter of provisional approval. Provisional approval letter would indicate some sort of a policy decision from the central bank that we are likely to give you a license, and that letter is given for them to get ready. I mean, procure necessary resources. For that purpose, a letter of provisional approval is given. It is generally valid for a given period, subject to maximum valid period of 12 months. Within 12 months, banking business can be commenced by the selected entity. Copy of the provisional approval and any extension of the provisional approval is given to Registrar of Companies. The reason being, Registrar of Companies will not register any institution with the term bank unless he gets a communication from the central bank. Now, no entity can be registered in Sri Lanka in the company registry, registrar's office, if they contain the words bank, banker, or banking, finance, and things like that. Those are referred to central bank. Now here, when the license, provisional approval letter is issued, it is given to the ROC as well. But the fact that letter of provisional approval was given is not a reason for the monetary board to give a license. The monetary board is not bound by the fact that it has issued the letter of provisional approval first. If the board is not satisfied with the suitability of the proposed company for some reason, if they are not compliant with the conditions of the letter of provisional approval, if it is revealed that the entity has provided false information to get the license, if there are significant change in the macroeconomic environment of the country, and in all those circumstances, central bank can refuse to give the license, even though letter of provisional approval has been issued. When the LPA, letter of provisional approval, is given, all advertisements, notices, whatever prospectus issued by the company after the LPA shall specify that it has not been issued with the license. That otherwise the letter of provisional approval should not be one should not hold out the letter of provisional approval and tell people that we have a license. It's not a license, it's only a provisional approval. Probably, I think the last license given to a local bank was Cargill's Bank. You might remember those days they were advertising for places and employees and so on. In all the advertisements, at the bottom, they have a clause to say that we are still not a licensed commercial bank. Right? They were recruiting people, they were doing hiring premises and so on. But in the advertisements, they say we are still not a licensed commercial bank within the meaning of the Banking Act. The reason is this: all approvals should tell the general public that it was not issued with the license as yet. Right? Licensing is issued with the minister's approval. It was there in section 2 itself. License can be conditional or unconditional. License may be subject to certain conditions, or it may be totally unconditional. And license may be given only for the purposes of establishment of a domestic banking unit, or an offshore banking unit, or both DBU and OBU. Okay? Generally, so this shows that the central bank can issue a license for someone only to do OBU. That's possible, but there are no circumstances in which the central bank has done so. Generally, DBU and OBU, both licenses, both units will be covered by the single license. It would show you the places or the area within which banking business may be conducted by the entity. It is necessary to display a copy of the license issued in a conspicuous places at Principal Office of Business in Sri Lanka and each of its branch offices. You know, when you walk into banks and in your workplaces, you see this license. Right? It is a legal requirement under the Banking Act that you need to exhibit the license issued to you. I think nowadays most of the banks exhibit it not by way of a physical document, by on their electronic screens and so on. However, it's a requirement that this need to be exhibited. Then license of LTBs further. And licensed commercial bank cannot conduct any business other than those specified in license and Schedule 2 of the Act. As I told you earlier, Section 2, Schedule 2 is related to licensed commercial banking business. They cannot do anything that is specified in license or in the schedule. But generally, the Schedule 2 contains a kind of a very broad provision which allows the monetary board to give permissions. If something is not particularly covered by the listed items of Schedule 2, a bank need to obtain specific approval from the monetary board to do something. There is a license fee payable by all the banks to the central bank. Monetary board has the power to cancel the license issued to a licensed commercial bank under Section 9 in certain circumstances. If they have failed to carry out banking business within 9 months of giving license, if they have failed to pay any debt, if someone has started winding up action, that is liquidation action against the bank, or if they cease to carry on banking business, if they are doing other things than banking business, if they have submitted false information on banking business, or if they are carrying on banking business in a manner detrimental to the interests of the depositors, in all these circumstances, it is possible that the license issued to LCB can be cancelled. Right? For completeness, I'll use this slide as well. Licenses of LSBs, licensed specialized banks. All up to this point, I was referring to licensed commercial banks. Not only them, LSBs also need to be licensed, but it is not covered under Section 2 of the Banking Act because this amendment came in later on in 1995, which recognized the existence of licensed specialized banks in Sri Lanka. So there are corresponding provisions. Section 76A requires no business of accepting deposits of money and investing and lending such money can be done in Sri Lanka without a license issued by the Monetary Board. So you see the definition of the business carried out by a licensed specialized bank is given here in it's indicated. No business of accepting deposits of money and investing and lending such money. That is how the business of a licensed specialized bank is defined in the Banking Act. So you cannot be accepting deposits of money and investing and lending such money without a license. You see here, there is no reference to banking business here, right? There is no reference to deposits payable on demand. What it says is you can't accept deposits and deposits of money and invest and lend such money without a license. That is licensed specialized banking. Section 76B says provisions of Section 3 applies. Section 76 says provisions of Section 5 apply. Again, Section 76F says Section 9 applies. You see, for example, Section 9 was dealing with cancellation of license. As much as cancellation of a license issued to a licensed commercial bank is covered by Section 9, cancellation of license of a licensed specialized bank is governed by Section 76 or F of the Banking Act. You see that these are corresponding provisions. 76B is dealing with the subject matters dealt with in Section 3 as far as LCBs are concerned. Likewise, this is a licensing process. Now, at this point, we would break for some 15 minutes and we'll next start discussing on the substantive provisions of the Banking Act. Right? We'll meet at 10:45.
Okay, sir.
Hello, are you there?
Okay.
Yes.
Oh, yes, sir.
Yeah. Okay. So I'll go into certain salient or certain specific features of the Banking Act and show how these apply to licensed commercial banks and licensed specialized banks, as the case may be. And probably we can relate these provisions to the rationale of the licensing of banks we have spoken up to the tea break. I told you a lot of things about nature of banking business and why banking business is special and the reasons of bank supervision, why they need to be subject to strict regulation and supervision throughout. And all these things can be clearly connected to the provisions of the Banking Act, which we are going to discuss now. You see that Section 12 of the Banking Act provides that to open or close bank branches, to offices or agencies or representative offices, to acquire business or part of a business of another licensed commercial bank or a licensed specialized bank, to merge or acquire or consolidate with another bank, to acquire the material interest of a licensed commercial bank. For all those things, the permission of the monetary board is required, right? Generally, in practice, I know that this has been done in a different way by delegating that authority to the deputy governor, and deputy governor finally subsequently informing the decisions and getting the ratification of the monetary board. But generally, for all these things, the monetary board's approval is necessary. You'll see that to open a bank, to close a bank, even a branch office, representative office, for all these things, that kind of a requirement, permission is required. This shows, I just wanted to show that all aspects of banks, even this kind of things, are subject to the scrutiny of the monetary board. This is basically why do we want to regulate where the banks, where the branches are going to be located. Now, all these things need to be scrutinized. Otherwise, there would be unnecessary kind of consideration in certain areas. Certain areas would be left out. You may remember some time back, after 2010 also, 2009, after the war, central bank had a specific policy. I can't remember the exact numbers, but what we said was, if you want to open a bank branch somewhere in the country, we had a policy. Policy was that unless you open X number of bank branches in the northern province and probably in the eastern province as well, you will not be permitted to open branches in other areas. For example, only if you open 2 branches in northern area, you will be permitted to open a branch in western province. Otherwise, what will happen is everyone will be concentrating their business into western province, and the provinces will be left out. So after the war, we had this clear policy: unless you open bank branches in northern province, you are not going to get further permissions to open branches elsewhere. Now it worked, right? This is a lot of banks coming into that area and starting business. Now, to do that kind of things, this kind of controls are there. This, you know, what is acquisition or part of the acquisition of business, then mergers and acquisitions and consolidation of institutions, all these are there. And also to acquire material interest of a commercial bank. For that purpose, again, you need to have central bank's permission, monetary board's permission. You'll see here in this slide, limit on shareholding that is dealt with in section 12(1)(c). This section says, an individual, partnership or body corporate shall not, either directly or indirectly, or through a nominee or acting in concert. with any other individual, partnership, corporate body, acquire a material interest in a licensed commercial bank without prior written approval of the Monetary Board given with the concurrence of the minister. So you can't acquire a material interest in a licensed commercial bank either singly or collectively with other people acting in concert. You see that you can't do that directly or indirectly through a nominee or acting in concert with others. You can't acquire a material interest in a licensed commercial bank. We'll see what is material interest. Material interest is holding of over 10% of the issued capital of a licensed commercial bank carrying voting rights. So if you can't acquire more than 10% of the voting shares of a licensed commercial bank. You can't acquire means a person cannot acquire, and also the person can't get together with other parties and cannot acquire more than 10% of the shares of a licensed commercial bank. Right? Acting in concert has also been defined. What it says is that it means acting pursuant to an understanding. That can be a formal contractual written agreement, or it can be even informal. To actively cooperate in acquiring a material interest in LCB so as to obtain or consolidate control of the bank. Right? If you are acting in a particular way with others with an understanding, it can be formal or otherwise, for the purpose of acquiring the material interest so as to obtain consolidate control of that bank. If you are trying to do that, right, alone, together with others, that is prevented because no one is in a position to acquire more than 10% of the voting shares of a commercial bank without the permission of the central bank. Now, what is the rationale behind this provision? We discussed this morning that licensed banks with this banking operation is a very fragile business. What it means is that shareholders put little money and collect a lot of money from depositors and use those depositors' money for a particular business. If you put that money into jeopardy, what it means is that entire deposit base is going to be destroyed. I mean, depositors are going into some sort of jeopardy. To prevent that, now if that is the case, you need to have control of the banking institutions with suitable people. And if there is unnecessary concentration among shareholders, then that is going to be very harmful for the interest of the depositors. Just imagine that if anyone can go and hold 100% of the shares of a bank, then that would be their own kind of empire. They will be getting other people's money and doing whatever they want, subject to, of course, restrictions in the Banking Act. But if a single person is going into this kind of venture, everything depends on his decision making. He has the control. That control may not be very democratic. That is why the law says you can go to the maximum extent of acquiring 10%. If you need to go beyond that, you need the specific approval of the Monetary Board. Without that, you cannot hold more than 10% in the licensed commercial bank. Now, the Monetary Board has considered, here we don't have a discussion, beyond 10%, Monetary Board's approval is necessary. Beyond this, Section 46 again recognizes certain relationships. If someone is coming up with that kind of a relationship, again, we have permitted up to 15% to be held with the permission of the central bank only. One can come up to 10%, but in certain circumstances, collective holding has been permitted up to 15%. If a particular banking institution is in need for capital infusion and so on, we would permit exceptionally for those institutions to go beyond section 15%, that is an exceptional specific approval need to be obtained. Now, section 10, the 10% approval is in the up to 10%. That is okay, that the law recognizes. 10 to 15% special approval has been given. If someone wants to go beyond 15%, that should be a very special approval to be obtained from the monetary board. Now, this is the shareholding general limitations. You may have heard of situations. Is there some disturbance? Is it only in my headphone, or is there any disturbance? Can you hear me, please? Can you hear me, please?
Yes, you're audible, sir.
Some disturbances there. Anyway, I'll go on. There were certain lot of instances in Sri Lanka where this 10% shareholding limit came into question. There were attempts some time back by certain persons to go beyond these limits. There were allegations that certain entities were acting in concert and sometimes controlling large stakes, something like 42% in certain other institutions, undercover, I mean, acting with other entities. Those things examined from time to time and necessary actions were taken. I remember for the last time in 2007, there were these directions where this 10-15 story that I mentioned earlier was recognized. I remember a particular situation where some particular investor who was a Malaysian national acquired shares in a particular commercial bank in Sri Lanka. He acquired shares in the share market. I remember he was going beyond, he was close to 10% at one point, and then he exceeded 10%. Right? But without the permission of the central bank. Then we advised that particular bank not to register his shareholding beyond 10%. Bank recognized only up to 9.99%. Right? Beyond that, bank did not register his shareholding in the books of the bank. He went up to 12%, and then realized that even if he acquires more than 12%, bank is not going to register anything more than 10%. So he stopped at 12, and our instructions were that he should not be paid any benefits for that excess amount. His dividends, whatever rights available in the rights issue, everything were limited to 10%. Right? He has provided money to the bank to other shareholders by acquiring shares, but he was not getting any benefit. And therefore, he, I think, finally disposed of those shares, and there was a dispute as to whether he was eligible to the dividends and other benefits payable during that time. I think we also assisted the particular bank, and the conclusion was that he was not entitled to, because he was acting against the law. There were a lot of other instances where this, as I mentioned, that certain considerations were discussed, but in all those circumstances, relevant directions were given and situations were under control. You see that under certain circumstances, it would be necessary to give permissions to certain institutions to go beyond 10% limit or 15% limit even. That is to facilitate some kind of a difficult situation faced by the bank. If there is some sort of new funds needed, you might have to get a new shareholder who might want a significant stake in the bank. Right? Those kind of things are very carefully examined. One thing I want to show here is that generally you saw that in relation to licensing and so on, all the provisions applicable to licensed commercial banks were made applicable to licensed specialized banks as well. But the section 12 is applicable only to licensed commercial banks. There is no corresponding provision applicable to licensed specialized banks. Therefore, 15% limit and so on, other things apply, not section something equal to section 12. These are the section shareholding limits as recognized in 2007 directions, which I mentioned earlier. You see 10%, then 15% with the permission of the MB, beyond 15% only with the exceptional circumstances. That is inadequacy of capital or insolvency or potential failure. If something like that is forthcoming, with the permission of the central bank, one might go into a stake of beyond 15%. This is about initial capital requirements of a bank. Section 19 in the case of LCBs and 76G in LSBs govern this requirement. What should be the capital requirement of a bank? If you are to start a new bank, what is the amount of capital that you need to bring in? According to Banking Act, the statutory provision, still it is there. There is 100 million and 50 million respectively. With 100 million, you can start a commercial bank, and 50 million LSB. That was the statute, what is available in the statute, but there are provisions to increase this from time to time. So the present requirement is 10 billion and 5 billion respectively. You see, it's a significant increase from the 100 billion. This was increased gradually from time to time. I remember at one time in 2005, LCB limit was requirement was 500 million and LSB's 150 million, right? Sorry, 300 million, 500 and 300. Then the central bank realized that there were certain developments that would necessitate increase in minimum capital requirement, and all of a sudden there was a decision that all the banks should increase their capital. The new requirement was 500 was changed to 2.5 billion. In other words, 2,500 million, and the 300 million expected profit LSPs was increased to 1,500 million or 1.5 billion. It was an increase of 500%, right? 5 times. But that was necessary at that time. There was a particular legal issue with regard to the authority of the Monetary Board to increase the capital requirement of a licensed specialized bank. So a particular bank went to courts against the central bank, but we managed to win that case. And with that, 500 million became 2,500 million. It now has come up to 10 billion. I think it is to be changed to 20 billion as well, probably in the near future. Then there is another requirement that no licensed commercial bank, licensed bank shall reduce its equity capital requirement without prior written approval of the Monetary Board. You see again here, what is the prohibition? You can't reduce your capital without the specific prior written approval of the Monetary Board. You see the rationale. I told you earlier that licensed commercial banks are running, banks in general, they are running with certain limited amount of capital contributed by the shareholders and lot of money contributed by the depositors who are creditors, in other words. So these are highly leveraged entities. Owners are contributing a small amount of money, whereas depositors are putting a lot of money. Now, in those circumstances, if we allow owners to gradually reduce their equity contribution, there is nothing contribute. I mean, that small portion contributed by the deposit equity holders, shareholders, owners further go down, thereby further exposing innocent, vulnerable, depositors. Therefore, this requirement is there. You can't reduce equity shareholding in a banking institution without specific prior written approval of the monetary board. That is to ensure that at least that capital contribution of the equity capital contribution of the shareholders remain intact, right? Otherwise, owners will not feel the shocks in the operations. Now, if their money is also involved, they know that they should not take unnecessary risks that are likely to put customers into jeopardy. To do that, we need to keep some kind of interest of them in the institution. That is why they are not allowed to reduce the equity capital holding without the specific prior written approval. Similar provision is there in respect of licensed specialized banks in section 76G5. Here, capital adequacy ratio is something the central bank will determine in terms of section 19.7 and 76G7 in terms of two categories of, for the purpose of two categories of banks. Capital adequacy ratio is determined by the monetary board, guided by the Basel principles. Right? You know the references to Basel 1, 2, 3, and so on. Those are the requirements. I mean, Basel is the international norm by which all the commercial central banks are kind of directed to, or central banks are basically guided by that kind of principles. Central banks keep on introducing them, looking at the new developments and so on. Their markets, the participants in their regulated markets are expected to go by those requirements. So, now, this is something about capital funds of a bank, which are defined in section 86. There are certain specific requirements. Please see this slide. What it says is, in the case of an LCB, licensed commercial bank, the equity capital and the reserve fund as provided for in section 20 and includes reserves other than funds reserved for specific purposes. Those are the capital funds of a licensed commercial bank. 70, again in SB, it has a similar corresponding provision, which says that the equity capital and the reserve fund maintained pursuant to directions under subsection 1 of 76J and includes reserves other than funds reserved for specific purposes. Similarly, these are supposed to be capital funds. Now, this is the definition. We'll see what are the effective controls. About liquid assets. Every licensed commercial bank shall maintain liquid assets in such percentage as may from time to time determined by the monetary board, having regard to the nature of the business carried on by such bank, which are not in a daily average each month be less than such percentage of the total of its liabilities, less its liabilities to central bank and to the shareholders, to the holders of non-redeemable debt instruments, and its liabilities on repurchase agreements in relation to treasury bills or securities issued or guaranteed by the government of Sri Lanka on such other assets as determined may be. The percentage, the central bank is allowed to determine that percentage from time to time. Would you please excuse me for 1 minute? So banks are required to maintain their liquid assets at certain percentages determined by the monetary board. Now, the liquid assets are determined as a percentage of their liabilities, but certain liabilities have been excluded in that calculation. We need not to go into that definition, the details. But what is this? Now, how do we collect this legal requirement, connect this legal requirement to what we have discussed earlier? Now, I told you that central banks would assist, extend the lend of last resort facility, or ELA, emergency liquidity assistance, in the case of certain situations, but not always. I told you that this central bank facility called LOLR is a discretionary facility given at the discretion of the central bank. It's not something that banks can ask for as of right. And I told you that LOLR is given to a bank which is illiquid. It is not given to a bank which is not insolvent, right? If it is insolvent, if it has to go down, it has to go down. That is it. But if an institution is illiquid, what it means is that there are reasonable chances of recovery. That is why we need to ensure that always banks are kept liquid. Liquid in the sense that, in other words, in simple terms, if the customers ask for their money, banks should not be having unnecessary difficulty in paying their money back. Therefore, there should be liquid assets. Now, liquid assets are determined in Section 86, and we can see what assets have been determined and what percentage of them should be maintained. But this liquid assets requirement comes in because banks need to be liquid. Otherwise, central banks might help them if the liquidity is not there. But ordinarily, they are supposed to maintain liquid funds. It should be 20%, 20 to 40% of the total liabilities of the bank, less its liability to central bank and to the shareholders. If we consider Section 86, you see that how liquid assets have been identified. Cash in hand, balances with LCBs. Generally, the most liquid form of money is money, cash in hand. In addition to that, certain other things are recognized. Balances with LCBs, because those can be easily coming in. Money at call in Sri Lanka, treasury bills and securities issued or guaranteed by government, maturity not exceeding 1 year. Goods receipts, import and export bills, such are the assets identified by the monetary board. These are supposed to be liquid assets, right? Against the total liabilities, except certain things, liquid assets should be maintained between 20 to 40%. You see that this requirement in Section 16 says that no company, firm, individual, group of individuals, or other than a licensed commercial bank or a licensed specialized bank may use these words as part of its name or description. What are the words? Bank, banker, or banking. Exceptions are that the monetary board can give written approval. With prior written approval of the monetary board, one can use these words bank, bank, or banking. Otherwise, it's totally prohibited for anyone to use the words bank, bank, or banking unless that entity is something licensed by the central bank as a licensed commercial bank or LSB, LCB or LSB. And also, no licensed commercial bank or licensed specialized bank can carry out banking business unless it uses one of the words as part of its name. Say any institution, any banking institutions need to have the words bank, bank, or banking in their name. right? Without those terms, you cannot carry out banking business. On the other hand, no one can carry out banking business. No one can use these terms uh, unless they are a licensed commercial bank. That is why register of companies would always refer this kind of a thing to the central bank, ask whether whether you have approved this, right? Sometime back, there was a newspaper advertisement, a full-page newspaper advertisement, which said, this was in 2009, I believe, if I can remember correct. There was a full-page advertisement in daily newspapers, which said, Data Central Bank is coming to Malawi. Data Central Bank is coming to Malawi. That was given in very large fonts, very large letters. That was the entire thing. It was not clear who put up the advertisement, but it says Data Central Bank was coming to Malawi. So almost all the central bank senior officers got a little disturbed seeing that, and has brought it to the attention of deputy governor, who asked me to look into that and see whether one can use the term central bank. Simply, my position was that there is no prohibition of using the term central bank, but we can see a problem because it contains the term bank. Anyone can, or in other words, it is not because they are calling themselves central bank, but within that term, the word bank is there. It is statutorily under section 16 of the Banking Act, it is prohibited. Therefore, whoever who has put up this advertisement might go into trouble if they are going to really do something. And then I was asked to do something, which I do. It was I saw that particular advertising agency's name in the margin of the newspaper. I contacted the advertisement agency and asked them who the client was. Client was a leading telecom company starting some sort of a kind of a data backup site for financial institutions. And I contacted them and explained to them the possibility of them being committing a crime. Then they immediately apologized and undertook not to publish, not to use the word bank after that. And that was the end of it. But we successfully stopped that because they were using the word bank, not because they were calling the central bank, right? These kind of things are there in relation to finance companies in the Finance Business Act. That is basically to prevent vulnerable people from going into unnecessary places thinking that it is a licensed bank. In Sri Lanka, you know the position. You don't have to call something a bank, but whatever the name it is used, if they say that they pay some 2% higher than any decent banking institution, people will run to that kind of places. In that kind of a culture, we need to be very careful that no one is using the word bank or banking unnecessarily. That is why this legal provision is there. Even though these things are there, we see unnecessarily because of lack of financial literacy or kind of engagement in this kind of things. A lot of people are running into illegal operators and finally lose their money. Section 17 of the Banking Act refers to the nature of the subsidiary companies licensed commercial bank may have. The basic rule is that a licensed commercial bank cannot have subsidiary company which is not a licensed commercial bank. If you are a licensed commercial bank, you can have a subsidiary company which is also a licensed commercial bank. That is permitted. But generally, a licensed commercial bank is prevented from having a subsidiary other than another LCB. Now, that is a general provision. For the purpose of this section, a subsidiary is defined. This definition contains three parts. One is that if a company is having more than 50% of the equity capital of another company, that means first one is the parent company of the second one, or the second one is the subsidiary of the first one. First one can be called a holding company. Second one can be called a subsidiary. If company A owns 50% or more than 50% in B, B is a subsidiary of A. And then the second proposition is that if a company, if the one company is a shareholder of another and controls the composition of its board. Now, in the first place, one company is having more than 50% of the shares of equity capital of the other company. Now, in the second one, there is no minimum requirement. A shareholder, a company is a shareholder of another company. And in view of that shareholding, they have the control. They control the composition of the board, right? So what it means is that probably company A, in my earlier example, company A had more than 50% in company B. Therefore, B was called the subsidiary of A. A was the holding company and B was the subsidiary. Now, in this situation, there is no requirement of having more than 50%. Company A may be having 2% shares in company B, maybe 2%. Still, for some reason, articles ensure that that particular entity is entitled to a position in the board. They can appoint a board member, right? That is then again, B is considered the subsidiary of A. Reason being that despite the shareholding limitation, at the board level, they can exert control. That is why this is supposed to be a subsidiary. When you say that there's an argument that this section says one company is a shareholder of another and controls the composition of the board. Some people argue that in order to come within this provision, in my example, company A owns some percentage, say 5% in company B, but company A can appoint a director to company B, right? Some people say it's not the ability to appoint one director, but the control of the director board should be available to that particular shareholder, and the directors appointed by them. What it means is that if it is a 7-person board, 4 persons could have been or should have been appointed by that particular shareholder. No, there is no requirement like that in section 17. Section 17 merely says, and controls the composition of its board. Controls the composition does not necessarily mean that it is having the majority on the board, but what it means is that you have some sort of a control over composition. It can be a single directorship. So if someone is having a kind of a lesser percentage, but at the same time, in view of that shareholding, has the control over composition of the board, at least even a single shareholder, single director, that then again, first company is the holding company of the second company, or second company is the subsidiary of the first company, right? Third one is that what we say is that company A is a company A may be having a subsidiary called B, B may be having a subsidiary called C. Then C is a subsidiary of A as well, right? Company A has a subsidiary which is called B. B has a subsidiary which is called I'm not sure at which point I got disconnected. I think it was while discussing investment powers of an LSB. Uh, as we mentioned, both LCBs and LSBs are generally prevented from investing in private companies. They need to invest in public companies within the limits, as I mentioned, which is 10% of the capital funds uh, in an entity, in the case of a licensed commercial bank or a specialized bank, and in aggregate, it cannot exceed 30% of the capital funds of a licensed commercial bank or 50% of the capital funds of a licensed specialized bank. In addition, in the case of a licensed specialized bank, there is another requirement, that is the investment cannot be more than 20% of the paid off capital of the investee entity. In addition, we discussed that the exceptionally both these categories can have certain shareholding. In the case of licensed specialized banks, if you happen to invest in a private company, uh, exceptionally, then that investment need to be divested to other shareholders within a period of 5 years, or that entity should be converted into a licensed specialized, a public listed company, so that again the investment is within the general applicable rules. Right, that is it. Now we can go into a new area, and which is a very important area as far as the banking sector regulation is concerned. Uh, that is about fitness and propriety of bankers of directors of licensed commercial banks. Now, again, this is connected to the very purposes of banking regulation I mentioned earlier. That is, banking is a very fragile industry. Banking is something that where you deal with other people's money. You need to be a very skillful as well as very kind of accountable person, very disciplined person to handle affairs of this industry. For the reason that you are handling other people's money, you need to have the relevant, necessary knowledge, experience, and skills. At the same time, you need to be a person of very good integrity. Otherwise, the money is put on introduced the deposited into the financial institutions by the depositors will be at risk. That is why the Banking Act requires the directors of the bank to be fit and proper persons, and directors and as well as key management personnel need to be fit and proper persons within the meaning of the Banking Act. What do you mean by a fit and proper person? If you look at these terms carefully, you can classify this fitness and propriety into two different areas and see that what is fit. Fit means that you must possess academic and professional qualifications and effective experience in banking, finance, business administration, etc. Right? You must be a person with academic and professional qualifications or effective experience in banking, finance, business, administration, etc. That is what makes you fit to be a bank director. You may be having a very good university degree in banking and related things, financial analysis, and things like that. You may be a professionally qualified chartered accountant or some other professional related to the services provided by a bank. Uh, or else, there are circumstances they have come across in Sri Lanka as well. There were certain persons who were not having very high education qualifications. I remember some people who have basically not achieved anything beyond their O levels, but they were very successful bankers with very effective banking experience. So this section allows any person who has qualifications, academic and as well as professional, and necessary effective experience, both those categories to be fit persons to be a bank director. At the same time, it is not sufficient to be a fit person, but at the same time, that person needs to be a proper person as well. What is meant by proper? Now, fitness is you possess certain qualities, educational, professional qualifications, and effective experience. You possess those things. That is what makes you fit. But what makes you proper is not that you are having certain qualifications, certain qualities, but you are not having certain particular characteristics. What are those things? Those are the wrongful things. If you are a kind of a convicted criminal, or if you have done certain things which involve fraud, deceit, and dishonesty, basically, if you have done someone, if you are someone who has done financial crimes, right? And if you are a person who is of insane mind, if you are not a sane person, right? If you are of unsound mind, if you are a bankrupt person, if you have been declared bankrupt, then these circumstances would show that someone is not proper to be a bank director. Unless someone is fit and proper, right, that person cannot be appointed as a director of a licensed commercial bank. That is how Section 42 is worded. So that fitness is basically academic and professional qualifications and effective experience. Propriety includes these things. Not subject to an investigation or inquiry by any such authority, consequent to a notice on any such act or any other criminal activity. If someone is subject to an investigation or inquiry by a particular authority, consequent notice on such authority, then that person becomes not proper. Maybe there are criminal investigations going on against someone, but nobody knows whether investigations are going on against a particular person. So if it is subsequent to a notice, right, then you won't be allowed to be a bank director. It's not a proper thing. If you are not convicted, if you are convicted by any court in Sri Lanka or abroad for a crime connected to financial management or offenses involving moral turpitude, then again you are not suitable, not proper, right? Just please connect these 1 and 2. Second one, if you are convicted, you are not a proper person. First one, where investigations are going on, you see that there is some sort of discrepancy here. In Sri Lanka, as in many other civilized legal systems, we don't presume anyone to be wrong or guilty of an offense unless charges are proved. On the contrary, the Sri Lanka's legal system recognizes that we have presumption of innocence. So until such time a particular person is prosecuted and court finds him guilty of an offense, we have the presumption of innocence. You might wonder what it is. Say there may be a situation where a particular person has done something illegal in the presence of 100 more people. See, A has killed B in front of 100 people. Still, A is not presumed to be guilty until he is found guilty by a court of law. Right? That is a presumption of innocence. So if the presumption of innocence is there only if someone is convicted by a court, we can call him as a convicted person. Otherwise, no. Otherwise, it's only it's only a suspect maybe. But in the first item here, what we say is not subject to an investigation. If you are subject to an investigation, you can be disqualified. Now you see that this goes beyond general norms of criminal law, because this is what we want. In the banking sector discipline, What we want is not that someone is not convicted. Maybe someone who is subject to investigation. If that investigations are serious enough for someone to become uh, serious enough for the central bank to consider that he is not proper, we would invoke that. And third point, not uh, not insolvent or declared bankrupt in Sri Lanka or abroad. If someone is declared bankrupt in Sri Lanka or in a foreign country, that kind of a person is not allowed to be a bank director, right? Uh, then not fair to satisfy any judgment or order of any court in Sri Lanka. It should be any court in Sri Lanka or abroad, or to pay a debt. What is court? Word court has come here. Or to pay a debt. Yeah, or to pay a debt. There's some sort of a confusion here. What it says is, if you have failed, if someone has failed to satisfy any judgment, right, then that person is not a fit and proper person. If you have in your personal affairs not settled alone, how can you expect to how someone can be expected to be of proper conduct in a financial institution? So if someone has not paid his debts, he is not allowed to be a bank director. Not declared by a court of, this is the this is a qualification, not declared by a court to be of unsound mind. If declared by a court as a person of unsound mind, then that person is not will not be able to be a bank director. Then this one, not removed or suspended by a regulatory or supervisory authority from serving as a director, CEO, or any other officer of a bank, financial institution, or a corporate body. If someone has been removed or suspended by a regulatory or supervisory authority from serving as a director, CEO, or other officer, then that kind of a person is not considered proper to be appointed to financial institutions. A person who has been removed. Then this one, if someone is a director, CEO, or held any position or authority in a financial institution or a bank whose license has been suspended or cancelled, or which has been or is being wound up, is being compulsory liquidated in Sri Lanka or abroad. Now look at this position. What it says is, if you have been in the financial institution of whose license has been suspended or cancelled, right, or which is subject to being liquidated, then you are not a fit and proper person, right? Not a proper person. What does that mean? Say, you know that when it comes to finance companies and so on, we keep on cancelling licenses of certain entities and so on. Suspensions, we talked about at least 2 suspensions of license of banks today, right? Now, if there is a suspension, that means if there is a cancellation, that means the director, this entity has not been managed properly. There was something wrong with the entity. If there was something wrong with the entity, and that something was so similar, so serious that it resulted in the suspension or cancellation of the license, then how can the persons who were in control of that entity be fit and proper persons? Therefore, any person who held the positions of authority in a bank or finance company of whose license has been cancelled or suspended, that kind of a person is not a fit and proper person to be a bank director. Now, this is a serious thing. Now, you may be working in a place, and that place is supposed to be, the license of that place is suspended or cancelled. By that reason, you also become not fit and proper. Therefore, you can't go to some other entity. Now, this is kind of a good kind of a filter. There are unnecessary people who have created problems in institutions, is looked after. I mean, those people are generally prevented from being directors or key management persons of other entities. How they are prevented? If now, when someone is appointed, they have to come to the central bank for clearance. If someone has been in an institution like that where their license has been cancelled or suspended, that kind of a person is automatically a not fit and proper person. So you might wonder what would happen in a situation like this. There is a company who has been doing pretty badly over the last 5 years, and their position was not good. The always NPS was high, and liquidity position was very questionable. They had a lot of issues. Likewise, they go on. Then on 1st of October 2021, that is yesterday, one of the directors of that company, which was doing very badly, resigned. After the resignation, maybe resignation was on 1st of October. On 4th of October, that is day after tomorrow, central bank decides to cancel the license of that entity or suspend the license of that entity. Right? So the directors of that entity would become not fit and proper to be appointed as directors of the banks. Now, does that mean that the person who resigned just 2 days before the cancellation or suspension is a fit and proper person? This is something questionable, right? He has been there throughout for last 5 years where all the problems arose within the institution. Now, just one working day before the cancellation, he resigned. Does that make that person a fit and proper person? On the other hand, there can be an institution which was doing very badly for last 5 years with the intention of recovering that place is the financial institution. A very respected gentleman who has been little inactive over last 5 years is coming in as a new director. That is to help the institution to come back, basically to perform well. Now, that person comes in on 1st of October 2021. But that particular fact is not known to the regulator. Probably that was not something that, in the sense, by that time there were certain proceedings, and the central bank decides to cancel the license of the entity on 4th of October. That is Monday. Now, does that necessarily mean that person who joined this entity on 1st of October should be a person who is not fit and proper to be a bank director? These are questionable areas. There can be people who have been basically in the institution, lived with the problem, who created the problem, who might resign just before the collapse. Or there can be the people who come into the institution just before the collapse. First category should not be, prevented from being disqualified, and second category should not be disqualified, right? I think that kind of a constructive approach should be always here, right? When it comes to operational areas, I have basically looked after this particular thing in mind, not because we don't go by the letter of law to see whether this has been appointed or not, or the date on which the license has been cancelled, and things like that. There are certain instances where this kind of things need to be looked at from a very purposive point of view. Now, I told you that in a particular institution, suspension was there only for 15 minutes, right? That again, for technical reasons, for us to intervene, there was a need for a suspension. So suspension was for 15 minutes. Now, if the suspension was at 4:30, at 4:45, we started the operations again. What is the situation? At the at 4:30, a set of people who were directors and key management persons of that entity, with the suspension, become not fit and proper persons. With that, they become persons not fit and proper. Then at 4:45, when we start the recommence business after the suspension, what is their position? we have a board of directors who are not fit and proper. Is that the case? Is it something logical, right? So we had that problem on that occasion as well. We decided that no, for technical reasons, the people who were identified as connected and responsible were removed within those 15 minutes, right? They were sent out. Certain people were taken in, and and uh, there was a need to retain certain persons. For example, just because technically someone is disqualified, uh, right? You cannot let the CEO to go in 15 minutes time. He has to be there to coordinate the revival of the entity. So we wanted certain people to stay, and on that basis they were allowed to work, and later certain determinations were there whether they were fit and proper or not. Now this statutory provision alone is not going to be the conclusive position, right? You need to be very careful in looking at them. But there again, there are a lot of circumstances where this provision comes into play. You may have heard of certain instances where people were removed and people were basically accused of being not fit and proper and so on. You need to have a very purposive and practical look towards these. One thing I would tell you is that this list of activities which make someone not fit and proper do not appear to be exhaustive as far as I'm concerned. I don't think that a person's improper nature is determined only in relation to these things. Statutorily, yes, these are the criteria given, but there can be very glaring circumstances where someone becomes not fit and proper, even though they are protected within the strict provisions of the statute, right? So we need to give not a very literal interpretation, but very purposive interpretation in relation to certain activities. Just imagine a particular director who is doing some unlawful activity within the institution, right? If you have evidence, if you have proof that he has done certain things, even if he is not coming within the specific provisions of these criteria, that person might have to be considered as not fit and proper. Right. This one, Section 42, has further provisions on how to determine fitness and propriety and so on. Section 42.3 is also very important. What it says is basically, if you are a director of a banking institution, licensed commercial bank, you cannot be a director of another licensed commercial bank or a licensed specialized bank unless that entity is a subsidiary or an associate company of the licensed commercial bank. Say you are a director of bank A, you cannot be a director of bank B as well. You know the reason. It's really a conflict of interest situation where the interest of one institution will go against the interest of the other institution. You know, even when people kind of resign from certain board positions or step down from their board positions, they can't join another bank unless they spend some sort of a cooling off period. These are governance and ethics related principles. Now, it goes without saying that if you are a director of one bank, you cannot be a director of another bank. If you are a bank director of bank A, you cannot be a director of bank B as well. But you can be a director of bank B at the same time if bank B is bank A's subsidiary, right? It can be a licensed commercial bank or licensed specialized bank, which is a subsidiary of the first bank, right? Unless that requirement is there, one cannot be a director of two banks. Right? Uh, why that exception is there? Because then it's not a conflict. You know that banks can have subsidiaries. That is the principal thing. Banks can have subsidiaries, which is a licensed bank. If they have a subsidiary, then interest of those two will be common. Right? Therefore, it's not a conflict of interest. It's basically complementary. Therefore, that person can be a director of that kind of bank as well. DBS may approve or refuse to approve an appointment, refuse to approve a nomination, appointment, nomination, or election of a director. The banks are supposed to inform director bank supervision of the nominations, appointments, and elections of directors. DBS has the authority to either to approve or refuse that kind of appointment, nomination, or election. Aggrieved party, the person who is aggrieved by the decision, who is supposed to be, who is declared to be not fit and proper, can appeal to the monetary board within 14 days of receipt of such notice. Then monetary board can look into that and monetary board can give the determination. When the monetary board gives the determination, again, there is a possibility of people going to the courts and so on. Probably who may be aware of a particular instance about 3-4 years back. All these procedures were followed. Certain people's while now one is that now what I mentioned here is that once before someone is appointed to the board of directors or appointed, elected, or once someone joined the board of directors, these fit and proper tests are done. In addition to that, while someone is a director of a bank, then again, while he is holding the position, if he has done something that comes within the scope of the not fit and proper persons definition, fit and proper persons definition, then again, the central bank has the authority to declare him a person not fit and proper to be a director. Right? That has also happened on several occasions. Central bank, for information received by the central bank in its examinations or otherwise, has declared certain persons to be not fit and proper, and asked them to step down from their positions. This is about licensed commercial banks throughout. There is a similar provision in section the part 6 of the section 76H, which deals with licensed specialized banks. It says parts 5 and 6 of the Banking Act shall also apply to licensed specialized banks, mutandis mutandis. What it means is that wherever there was a requirement in section 5 or part 5 or part 6 of the Banking Act pertaining to directors of licensed commercial banks, those are applicable to directors of licensed specialized banks as well. In view of certain other sections of the Banking Act, I think section 44, these tests apply not only to directors but key management persons as well. Those who have been identified as key management persons of banks are also subject to all these tests. For example, say if you are the CFO, Chief Financial Officer of a bank, you need to be a fit and proper persons within this criteria. How we determine fitness and propriety is that anyone who is getting appointment to the industry need to submit an affidavit giving necessary details pertaining to all these areas. Now he might have to give information about his and his family members details and about their financial commitments, whether they have been declared bankrupt and whether they are having financial interests with other entities, and all these things are given. After examination of all these things, central bank makes a determination whether someone is a fit and proper person or otherwise. Right? This is the procedure, kind of one of the instruments through which the banking sector people are kind of filtered. Now, sometimes there is this criticism that this filtering process is too strict, that they cannot recruit, they cannot get the services of very qualified persons. But at the same time, you would appreciate that qualification is one thing. With qualifications, one might become fit. But if the other details of the person makes him improper, makes him not proper to be a bank director, then we need to be very careful, because fit persons are very dangerous when their conduct is improper, rather than some average person doing something wrongful. If a very qualified person is up to some wrongful thing, I mean, decisions can be, the results can be very devastating. That is the reason why one can be, when one needs to be fit as well as proper. Just because someone is qualified and having experience, we cannot dispense with the requirements pertaining to propriety of the person if his conduct is not acceptable. He is likely to be rejected on the basis that he was not fit and proper. Right? Now, this is something applied all over the world in different forms. Sometimes regulators go into subtle details such as uh, executive pays as well, right? Executive, in the sense that how much senior executives are paid, how their salary structures, and so on. In global financial crisis related developments, a lot of countries impose restrictions on their executives' payments. Now, in Sri Lanka, in the case of certain things, uh, probably strict decisions will have to be taken to control certain practices. Right? Those are the kind of tools available to a regulator to have the relevant sectors kind of discipline, so that unnecessary things do not happen. Uh, there are few slides left here. Uh, we'll go into them probably next week. Right? Now, or else, yeah, we'll somehow cover these left out parts as well. I'll come up with the proper schedule from next week onwards. Right. We'll stop here today, and again we'll meet next Saturday at 8:30.